Welcome back to another video with us at EDU-Tutor. Today we'll be looking at Principles of Accounts, January 2025, Paper 2. Alright, so let us begin. Number 1 says, House of Razzle Dazzle operates a clothing and accessories store. The following list of transactions occurred during October 2024. We're supposed to use the forms provided on pages 5 to 7 to prepare journal entries for the above transactions and label each journal, as well as record entries for each transaction in the appropriate journal, complete general journal entries with suitable narrations, and balance and rule the cash book at October 31st, 2024. So let us start with the first transaction. It says October 3rd, received an invoice for goods for resale from Z Fashion House, $6,000, less 25% trade discount. Firstly, what are the different journals that you have? You have your purchases journal, sales journal, returns outwards journal, returns inwards journal, cash book, and petty cash book. 7 of them, right? And did we say general journal? So that's 7. Which one of those journals will you record this transaction in? So when you're selling goods on when you're buying goods on credit, that is related to your purchases journal because you will record goods sold on credit, goods bought on credit in your purchases journal. So we scroll down, you would label one of your journal as purchases journal. In our case, I did it already, so we just go down to purchases journal. It happened on the 3rd, Z Fashion House. And it was $4,500. How we get $4,500? That is $6,000 multiplied by 75%. Or if you multiply it by 25% and then subtract it from the $6,000, it will give you the same as a 4,500. So there's 2 ways to do it. Whichever way you choose, it will give you the same answer. I'm going to put both methods there so that you don't get confused. So after you do 6,000 multiplied by 25%, you would now minus it from the $6,000 to give you 4,500. All right. Continuing, so we move to our next transaction. It says that on the 6th of October, cash register tape showed cash sales totaling 13,954. Which one of your journals will you record this in? Your cash book, right? So you're going to look for your cash book. You're going to ask yourself, when you are receiving money, which side does it go on? Does it go on your debit side or does it go on your credit side? Cash is an asset, and once you're getting assets in the business, it's going to be a debit, right? So it's 13,954 for your under your cash. It's going to be the 6th of October for the date. The other account that is affected is sales, and you find this transaction in your general ledger. Remember that you have 3 ledgers: your purchases ledger, your sales ledger, and your general ledger. Purchases ledger is for payables. So anything that affects a payable will go in your purchases ledger. Your sales ledger is for debtors or receivables. So anything that affects your debtors or your receivables will go into your sales ledger. And every other transaction, it goes into your general ledger. All right, so that is it for that transaction. We go back up. We're at the 3rd transaction, which says that 7th of October we paid advertising expense in cash 2,600. Again, this is going to affect our cash book, but this time we're making a payment and it is 2,600. So it goes on our credit side. So we get October 7, advertising expense, it will be our details, right? And we find this transaction in your general ledger since it is not affecting a payable or a receivable. And it is 2,600 under our cash column. We move on, we go to October 12. No, it's October 8th. Bank $10,000 cash. What kind of entry do we call this? What kind of transaction is this? So it will be both aspects, both the debit and the credit will be found in our cash book. So what do we call this? We call it our cash or contra entry. Sorry, not our. All right. So it's a contra entry. We have October 8th. On our debit side, we're going to show that the money is going to go into our bank. So it's $10,000 on the bank account, and the details will be cash. On the credit side, we're going to show that the money is leaving the cash till. So it becomes $10,000 under the cash column and bank for the details. All right. So both aspects of the transaction will be found in your cash book. And then we have the 12th of October, received a credit note from Z Fashion House for goods returned undamaged as damaged, costing $1,800 less 25% trade discount. At the same time that you get something like this, you're going to work out the discount. What is 25% of 1,800? Then you subtract that from 1,800. You should get 1,350. It's the same thing as if you multiply 1,800 by 75%. All right. So which journal is this transaction going to affect now? We're returning goods to the fashion house, right? So it is the return outwards journal that is being affected. We go to returns outwards. It's October 12th. The fashion house will be the details, which is the name of the creditor. You find this transaction in our purchases ledger because it is related to a creditor. So once it's related to a creditor, it is found in our purchases ledger. When you did 1,800 multiplied by 75%, you should receive or you should get 1,350. If you did it the long way, where you did 1,800 multiplied by 25%, you would have gotten 450. And when you said 1,800 minus 450, you would have gotten 1,350. And I'm saying that this is the same thing as 1,800 multiplied by 75%. All right. So I hope you get this concept before we finish this video. So when you're working with percentages, you have different ways to work with it. All right. We move on to the 14th of October. Received an invoice totaling 4,790 for additional shelves and mannequins for business use from Display House. What are shelves and mannequins to the business? Is it goods or is it assets? It is asset. So in the case that it is an asset, we know that we don't record the purchases of assets in our purchases account. We will record it in our general journal. So we go down to our general journal, and when we're receiving assets will increase, and when assets increase, we debit. So we're going to say the 14th of October, shelves and mannequins, which we can find in our general ledger, since it is not a payable or a receivable, and it's going to be 4,790. We're going to indent for the account that we're going to credit, and Display House would be the account that we credit, which is the name of the supplier. And since he or she is a supplier or creditor, the folio would be purchases ledger, right? And it is 4,790. We also need a description or a detail, and it's going to be to record the purchase of a fixed asset on credit. Now, your detail or your description may be different from mine, but once we're saying the same thing in different words, then it will be correct. Move on to the 18th of October. We issued an invoice to Queen Bee for goods, $3,600 less 15% trade discounts. So, what is 15% of 3,600? Is that 540? And what is 3,600 minus 540? All right. So that is what we're going to put for this transaction. Which journal is this affecting? All right, so sales, good. So on the 18th of October, the details would be Queen Bee, which is the name of the customer we are selling to. The folio is a sales ledger because it's a customer. Customers are related to their sales ledger, and it is 3,060. All right, which is 3,600 multiplied by 85%, or 3,600 multiplied by 15%, and then you minus your answer from 3,600. All right. Now we move on to 19th of October. We returned $1,200 worth of the additional shelves purchased on the 14th of March from Display House. All right. So we previously purchased some assets from Display House. Now we're returning some of them. So we go back to our general journal. And in this case, we do the opposite of what we did before. So October 19, we're going to debit Display House to show that goods are going back to him. So we no longer owe him for those goods. It will be related to the purchases ledger because that is where we find our suppliers and creditors, and it's $1,200. We have to indent for the account that we're going to credit, shelves and mannequins, general ledger, and it is $1,200. Alrighty. And it is to record the return of an asset. We move on to the 25th of October. We issued a credit note to Queen Bee for goods, $460 less 15% trade discount. What is 15% of $460? And then subtract that from $460. So Queen Bee, the customer, is returning goods to us. So that means that is return inwards. So that is affecting our return inwards journal. So we scroll down, we create one for return inwards. And it's going to be the 25th of October, Queen Bee. And you should get $391. Right, $391. And it's going to be the sales ledger. You have to make note of that. Then we go to the 27th of October. We pay Z Fashion House by checking settlements of his account at this date, less 2% cash discount. So what you realize, they don't tell us the amount that we're paying. So you have to calculate that. Remember that earlier we bought goods from Z Fashion House, getting a 25% trade discount. We also returned some of the goods, $1,800 less 25% trade discount. So how much do we owe him? All right. So what you're going to do, you're going to look for all those transactions. So we had 1315 here for Z Fashion House, and we also had 45. Right? 45 minus 1350, which is the goods that we sent back to the Z Fashion House, is what? That's 45 minus 1350 is equal to $3,150. And what is 2% of 3,150? Because they said that we're going to give a discount. That is 63, right? So in total, we're going to be paying $3,087, which is going on our credit side because it's a payment, and the folio is a purchases ledger since the fashion house is a creditor, right? Now we move on to the last transaction, which is the 29th of October. We received a check from Queen B in full settlement of its account at this date, less a cash discount of $175. So it's the same thing here where they don't tell you the figure. What you're going to do, look for all the transactions that are affecting Queen B. So we sold goods to Queen B for $3,060, and then Queen B returned goods to us for 391. So 3,060 minus 391 is what? 3,060 minus 391. And then you minus 175 from the answer, which is the discount that we're going to be giving to her. Did you get 2,494? Yes. All right, so that's the answer. So now that we have completed all the list of items, it is time for us now to balance off the account, transfer the totals of the journals and all of that. So a general journal, it is complete the way it is. For return inwards, we have to go to the end of the month. If there are more than one transactions, you would have to total them, but in this case, each journal only has one. So it's going to be transfer to return inwards account, being that we're dealing with the returns inwards journal, and it's going to go to the general ledger, and it's 391. For the returns outwards journal, same thing, October 31, but you're transferring it to the return outwards account, general ledger, 1350. For the sales account, you're going to transfer it at the 31st of October. Transfer it to the sales account in the general ledger. And for purchases account, it's going to be the fashion house 45. Sorry, it's going to be October 31st. Transfer to the purchases account for 45. Lastly, for your cash book, you need to balance off. So let's imagine that we don't have this part from balance CD going down. On our credit side, on our debit side, we'd have $13,954 on our cash, on the cash column. On the credit side, we have 26 and 10,000. So that gives us 12,600. So you're going to minus the 13,954. So 13,954 minus 12,600. And that should give you 1,354. You put it on your credit side since this was the side with a smaller total. And that becomes your balance CD October 31st. Now you're going to add. So if you add 1,354, 10,000, and 2,600, you should get 13,954. So you total both cash columns, and you go on the opposite side, you put your balance BD for the first of the following month, and it becomes 1,354. On the debit side, 10,000 and 2,494 gives you 12,494. You had 3,087 on your credit side. So you said 12,494 minus the 3,087 will give you 9,407, which goes on our credit side because it's the side with a small amount. Now you need to add 9,407 plus 3,087 to check if your answer is correct. And once you get the 12,494, you total both sides. Go on the side with the larger total, and it will become your balance BB. All right, so that is the answer. That is how you balance off. And we move to question 2. Question 2 asks for some definition. It says Brown Legged Limited manufactures animal feed and has many employees. We're supposed to define each of the following pay systems which Brown Legged Limited may use to calculate gross pay. Your definition may be a little different from mine because we're going to be using our own words to give a definition for a phrase or a statement or a word. In this case, it's fixed rate. So we can describe a fixed rate as a set or predetermined payment amount or system for a specific period of time, which does not change over that time period. The hourly rate that would be considered a dollar value or amount paid to an employee per hour of work that they do. Piece rate A piece rate is usually used in places where you are going to be producing something, right? So it is a remuneration method or a compensation method where an employee is paid based on the quantity of items or units of products produced. And then we have our commission plan, which is a percentage or a fixed amount that is paid based on the number of sales completed. And then your bonus plan, right? Your bonus plan is usually extra money or extra compensation that is given to an employee on their regular wage because they would have met some criteria, some goal, or some targets. All right, so now it says complete the table below to show the name of the account and ledger affected when posting totals from the journals identified. In each case, the double entry rule must be observed. An example was done for you. All right, let's look at the example. Return inwards. So when you get some return inward, which account do you debit? Which account do you credit? Right. So you normally debit return inward since the goods is going to be coming into the business. Goods is an asset and it increases. And when an asset increases, we debit it. So we debit return inwards account. And then we credit sales ledger, control account, or the receivables account. Now that we have the name of the accounts, right? You are going to ask yourself, where can we find these accounts? So we find the return inwards account in the general ledger. And remember that there are three ledgers: general ledger, purchases ledger, and sales ledger. So in your purchases ledger, we find the suppliers or the creditors. In the sales ledger, we find the receivables accounts, and in the general ledger, we find everything else. So in this case, we have our accounts receivable account. We find that in our sales ledger, and then we find this in our general ledger. All right. Now we move on to the sales. When we make a sale, we normally, and it's on credit we're talking, we normally debit account receivables and credit sales. You can also debit sales ledger control account. Where do we find it? We find it in our sales ledger. And we find our sales account in our general ledger. All right. For the return outwards, we normally credit return outwards account, debit payables account. Where do we find our payables or our purchases ledger control account? In our purchases ledger. Where do we find our return outwards account? In our general ledger. All right, so as simple as that. That is what they're asking you to tell them. Then it says state the accounting principle applied in the situations below by writing the corresponding item letter from table 1 in the spaces provided in the second table below. You have prudence, true and fair view, objectivity, going concern, and accruals. Brown Legged Limited applies a depreciation charge on assets each year over their economic useful life. That is the prudence concept. All right. It is policy at Brown Leggy Limited that all accounting information should be based on verifiable evidence such as invoices and checks. That is objectivity. Must be able to be proven. Sales are not recognized when goods are paid for in advance. That is accruals concept. And then you have Brown Leggy Limited ensures that all financial statements are accurate reports on the performance of the company. That is a true and fair view. All right. Still on Brown Leggy Limited, they decided to compare the company's ratios on December 31st, 2025 with those on December 31, 2024. So let us look at them. Collection period for the receivables at the year ended of 2025 were 35 days. For 2024, we had 45 days. What do you see? Do you see an increase or do you see a decrease? So they did this to confuse you. Remember which year comes first. 2024 came first, 2025 came second. So in this case, it is a decrease. This is a decrease because we went from 45 days to 35 days. Then for payment period for payables, in 2025 it's 40 days, in 2024 it's 30 days. So here we see that is an increase. All right. In each of the ratios shown above suggest two possible reasons for the change between December 31, 2024 and December 31, 2025. Change in the collection period for the receivables ratio. So I gave two reasons. Your reasons can be different. Once it is once it makes sense that could suggest why there's that type of change in the receivables ratio, then it is correct. So my answers, I said that total credit sales issued to each receivable may have been reduced. So if we usually issue $1,000, we might have started to issue $500 to those persons who we know take long to pay, right? And in so doing, those persons will be able to pay off their debt at a faster time and then they can borrow more. Reason two is that cash discounts were increased to encourage swift payment. Remember, cash discounts, they how they are is like you say, if you pay your debt within 15 days, you get a 30% discount. Of course, with that, you are going to want to pay off your debt in time so that you can get that discount. So that is what would encourage you to take less time to pay off your debt. Then it says change in the payment period for payables ratio. We had 40 days in, so we said that there was an increase in payment period for payables. So we took longer to pay for our debt. And it could be a case that the business generally was low on cash, right? So maybe we're experiencing bankruptcy or some money was tied up in some other form of investment, or we just had a low working capital. Reason two, I said that trade discount was reduced, which did not encourage early payment. So maybe the discount that the payables were given to us, it was so low that if we pay it later at a later date, it will be the same effect, right? To us. And then it says identify one possible outcome which could result from the business not having adequate working capital. And we know that working capital is what we use to finance our day-to-day operations. So therefore, if we don't have anything, we can't pay our current liabilities, right? And we cannot run the business properly. So we need a long-term loan. We possibly have to take out a long-term loan. Question three says define the term depreciation. And we all know that depreciation is a loss of value of an asset over a period of time, usually because of wear and tear and erosion and those things. On January 1st, 2023, Kali Honas, the owner of Kali's manufacturing company CMC, purchased a delivery truck costing $50,000. He is undecided on whether to charge depreciation using a straight line or reducing balance method and has made the following decisions. Useful life is estimated to be 5 years. Estimated scrap value is $10,000. Depreciation rate for the reducing balance method would be 25% per annum. Complete the table provided below to show annual depreciation charges for the straight line and the reducing balance method for 2023 and 2024. All right, so how do we calculate straight line method of depreciation? Right, so it's the cost of the asset minus the scrap value divided by the number of years. What is the cost of the assets? 50,000. What is this? The useful life? 5 years. And what is the scrap value? $10,000. So we get 50,000 minus 10,000 divided by 5 years, which gives us 8,000. Now remember, for straight line, the depreciation per year will be the same, so it's $8,000 for 2024. But you still have to show your working, so you put the 50,000 minus the 10,000 divided by the 5. For the reducing balance, depreciation every year will decrease. So how do we calculate it for the first year? It is the cost of the asset, which is the 50,000, multiplied by the depreciation rate, which is the 25%. All right, and we get 12,500. For the second year, however, we have to minus the depreciation that we got in year one from the cost of the assets. And that will give us what we know as the net book value. So it is 50,000 minus 12,500, which will give us 37,500. Now that we get the 37,500, we multiply it by the rate, which is 25%, and that gives us $9,374. We don't focus on the scrap value in this case. CMC's accounting staff presented the following information. Which one of these is the open inventory? So we have raw materials inventory and work in progress. So we look at the date. January 1 would be the open inventory. December 31st would be the closing inventory. Good. And then additional information. Purchases of raw material, 142,500. Direct labor costs during the year, 197,500. And factory overhead costs during the year is 141,250. We're supposed to prepare CMC's manufacturing account for the year ending December 31, 2024 using the form provided below. All right, so we're going to start with our opening stock of raw materials. And that is 47,500, which we got here. We're going to look for purchases of raw material, which we got here. And that becomes 142,500. When you add these two figures together, you get 190,000, and that is the cost of raw materials available. Then you're going to less your closing stock, which is the $60,000 up here. And that will give you $130,000, which is the cost of the total raw materials that we used up. Then we're going to add factory overhead. We're going to add all our other direct expenses. And in this question, we only have direct labor other than the direct material. And that gives us 197,500. When we add 197,500 with our cost of raw materials used, we will get 327,500, which is our prime labor, prime cost, I should say. Then we're going to add all our other factory overheads. So we have 141,250 because they gave us the figure here, so we don't have to do a lot of working out. 141,250 plus 327,500 will give us 468,750. Then we add our work in progress, starting with our opening work in progress. And in the question, you can see it at the top here that it is $20,000. When we add 20,000 with 468,750, we get 488,750. Then we less the closing work in progress, which is the 18,750 at the top here, which will give us a production cost of $470,000. All right, so that's the answer for C. Now we go to D. The company manufactured 22,500 units, and we're supposed to compute the unit cost of production. So we can see up here that the production cost was 470,000, and that was used to produce 22,500 units. If we want to know how much it is to produce one unit, we divide the total production cost by the total number of units, which will give us 470,000 divided by 22,500, which gives us a total of $20.89 per unit. And then CMC has a markup policy of 60%. We're supposed to calculate CMC's total unit selling price. There's two methods that I placed here for you to use. You can either use method 1, where you multiply 60% by $20.89, which will give you your profit. And then you're going to add your profit with your cost, and that will give you $33.42, which is your selling price. Or you could do it a simpler way. Remember that a whole is 100%. You want the cost plus the 60% of the cost. So you multiply it by 160, which is the whole plus the 60%, right? So $20.89 multiplied by 160% will give you $33.42. You can try both of them in your calculator and you'll see that they're both correct. Then we move on to F. The company sold all 22,500 manufactured units. CMC's operating expenses are 20% of sales. We're supposed to calculate the value of the expenses. So first we have to find total sales because they told us that expenses is a part of sales or a percentage of sales. We have to know what the sales is first. So if we sold 22,500 units and we sold it at the price that we just calculated at the top here, which is $33.42, we're going to be making $751,950. So it is the number of units, which is the 22,500, multiplied by the 3342. All right. And then that would be our total operating expenses. Sorry, that would be our total sales. So we're going to find our operating expenses by multiplying the 20% of the total sales, which is 751,950 multiplied by 20%, which gives us 150,390. All right. Now we're at question 4. Ray's Appliances shop sells small kitchen appliances, including air fryers. He uses the AFCON method for inventory control and valuation of the air fryers. Identify one other method of inventory control and valuation that Ray could have used. He could have used FIFO or LIFO. State briefly how the method identified in A works. If you stated FIFO, you could have said that the first set of goods that are bought into the business are the first to be sold. If you stated LIFO, you know that LIFO, in that case, the last set of goods that come in the business are the first to be sold. Then it says during the month of December 2024, the following information is available for the movement of fryers. Complete the form provided on page 16 to record the inventory valuation of air fryers for the month of December 2024 using the AFCO method. And we're supposed to round off all calculations to the nearest dollar. This is important. A lot of persons didn't see that. So let's underline it. Let's move along. Starting with December 1, balance on hand is 502 units at $200 cost. So we're going to say December 1, it is unsold inventory from the period before, so it's 502 at an average cost of $200, which gives us a total value of inventory on hand of 100,400. How did we get this? We multiply 502 by 200. All right, and we get $100,000, 100,400. All right. Then it is the 6th of December. Purchases was 125 units at $230. So we're going to say cost of inventory coming in since we're purchasing the goods. We purchase it at 120. We purchased 125 units at $230. So we get 28,750. We're going to add the number of units that we had before with the number of units that we just purchased, which gives us 627. Then we're going to add the value of inventory on hand from the period before, which is our opening balance, plus the ones that we purchased, 28,750, divided by the number of units, which gives us a average cost of $206. All right, so it's 206. So we multiply the 627 by the 206, which will give us 129,162. So remember, we round off. So it gives us $129,162. And then we move on to the 13th of December, where we sold some goods, and the number of units that we sold is 257. So December 13, we sold 257 goods at the average cost of $206, which gives us 52,942. Then we're going to minus the goods that we sold from the goods that we had before. So it's 627 minus 257, which gives us 370. Remember that our average cost was 206, it's still going to be the same. Then we're going to multiply the goods that we have left, which is the 370, by the 206, which gives us 76,220. We go back up to our list of transactions. On the 19th, we purchased goods of 175 units at a cost of 245. So we're going to look for the 19th. 175 units at 245 will give us $42,875. Remember that we had 370 from the period before or the week before, and we have no 175. We just got 175. So we're going to add 370 and 175, which gives us 545. The 76,220, which is our value of inventory on hand before, plus the 42,875 that we just got, divided by the number of units, which is 545, give us 219, and this is rounded off. 545 multiplied by 219 will give us 119,355. For the 23rd, we move on. Sales of 322 units. So we're going to show that. So we go in, goods leaving the business, our inventory going out, and we say 322 multiplied by the 219, which is the average cost, will give us $70,518. 545, which is the number of units that we had, minus the 322 units that we're selling, will give us 223. And we have it at a cost or average cost of 219. So it's 223 multiplied by 219, which will give us $48,832. $48,832, which is the value of inventory on hand. So now we're at the 29th. We did some purchases and the number of units is 200. The cost is 260. So we go to the 29th. We had 200 units coming into the business at 250, giving us 52,000. We added 223 units to the units that we had before. We just got, which is 200, and that gives us 423. We add our value of inventory that we had previously, 48,832 plus the 52,000, and divide it by the number of units that we now have, which gives us 238. And we multiply 238 by the 423 units, and that gives us 100,600. $114, which is our value of inventory on hand. And then December 30, which is the last one, is sales of 410. So 410 multiplied by the 238, which is our average cost, will give us 97,580. 423 minus the number of units that we just sold will give us 13. 238 is still our average cost, and 13 multiplied by 238 will give us $3,094. Then it says calculate Ray's total cost for purchasing air fryers in the month of December 2024. So you're going to look in your purchases row, which is the cost of inventory coming in, and you're going to add all these figures. So 28,750 plus 42,875 plus 52,000. And that will give you 123,623. That is his total cost of purchasing fryers. Then it says Ray sells an air fryer at the price of $650. So we're going to calculate the total revenue for the sale of air fryers for the month of December 2024. To calculate this, you need the total sales. So you're going to go up to the question, look for sales. So let me draw the line so you can follow me. So sales here is $257. So you're going to put that in your calculator. $257. Not dollars, units. Then 23rd of December, it is 322 units. So you're going to add that to the 257. And lastly, you're going to add this one, which is 410. What is your figure? 9989, right? So your revenue would be your total sales multiplied by the selling price. So it is number of units sold multiplied by selling price, which gives us 642,850. This is where we got the 650, which is our selling price. All right, if you have any questions, you can comment below the video. Now it says prepare an income statement using the form provided below to show the gross income earned by Ray's Appliances shop for the sale of air fryers for the month of December 2024. The income that we just got was 642,850, right? That is the total sales or the total revenue. Good. We're going to less cost of goods sold. Open inventory was 100,400, which is the value of inventory on hand at December 1. Remember, they told us that that was a balance on hand, which would be our open inventory, right? Then we're going to add our purchases, and we just calculated our purchases up here, where we said that it was 123,625. Good. When we add our purchases to our open inventory, we get $224,025, and then we less our closing inventory, which is what we ended our AVCO method with. We got $3,094, right? And when we less that, we get 220,931. So we minus our cost of goods sold from our income, and that gives us our gross profit of 421,919. And finally, we're at our last question, which is number 5. It says Costco Sports Center has a health, recreational, and social facility. The trial balance on December 31, 2024 did not agree. It was short on the debit side by 368. This was entered in a suspense account. The account's clerk later discovered the following errors. Alright, so as we read the errors, we are going to determine whether it goes in the suspense account or in the general journal. We're supposed to prepare the suspense account to correct the errors from the table above, which require correcting by the means of a suspense account. Start with the difference from the trial balance and total the account. And then we're going to prepare the journal entries to correct the error, which do not require correcting a suspense account. Include a suitable narration for each entry. So we're going to do each of these at the same time. Let's start with the balance. So it says the debit side was short 368, so we're going to put that on the debit side of our suspense account. So we put balance BD at December 31, 368. Let's start with items. No. So items one, the so I'm going to stick the ones that will go in our suspense account blue, and the ones that we put in our general journal red. So let's start with one. The total of a page. Let me remove this first. Okay. The total of a page of a purchases account was $6,842, but it had been carried forward as 6,824. What do you realize? One total is larger than the other. And we realize that it should have been more. So once it should have been more, we need to put it on this the in our purchases account. We would have to debit purchases $18, but we would not have anywhere to credit, right? So we have to credit suspense. So we go at December 31st. We're going to have the details for purchases because that is where we're going to find the debit part of this transaction. And it's going to be the $18, which is 6,842 minus 6,824. On the second item, so this was in our suspense. Second item, a check received from DEC Limited, $1,500, has been credited to the account of DDE Limited. All right, how would we correct this error? So remember now, we would have to remove it from the EC account first, right? So that means that we have to go and debit DEC's account to remove it because it was previously credited. So we have to do the opposite, which is to debit. And now we have to credit DDE Limited. So that means that this transaction will not go in our suspense account, being that both we have places to put both the debit and the credit. So this is red. This goes in our general journal. Let's look in our general journal. So as I said, we have to debit DDE account, which is where we put the transaction in the first place. When we debit, it's going to cancel it out. And then we're going to credit DEC. So we have to go and indent DEC Limited and then credit it the 1,500. This is what we should have originally done. So that is this is what we should have originally done. And this is to correct the error of commission, which is a type of error that it is. And we move on to 3. The balance of the petty cash book, $200, has been omitted from the trial balance. All right, is this going to be affecting the suspense account? We should have had a balance of $200. And what kind of balance does a petty cash usually have? A debit balance, right? So that means that we should have debited petty cash book, but what would we have credited? We don't have an account to credit, so we credit suspense. So December 31st, petty cash, $200. All right, so we find the debit entry in the petty cash book, our account, and we have $200 on the credit side. Great. For question 4, repairs to motor vehicle, $293 has been debited to the motor vehicles account. So we shouldn't have put it in motor vehicles account. We should have put it in the repairs motor vehicle account. We have to remove it from the motor vehicles account and put it in the repairs account. So how are we going to do that? Since it was previously debited to motor vehicles account, we have to credit motor vehicles to remove it. So we're going to credit motor vehicles account, and we have to debit motor vehicle. Then we have to debit repairs to motor vehicles, since that is what we should have originally done. So this means that we're not going to need suspense because we have both a debit and credit entry to correct this error. All right, so let's scroll down. So as I said, we're going to debit motor repairs because that is what we should have done in the first place. and we're going to remove it out of the motor vehicle account. In order to do that, we have to credit since we previously debited. And we of course have to indent for the account that we're going to credit. And we have to have a description, which is the correct error of principle. Your description might be a little different, but once we have the same meaning behind it, then it's okay. The fifth item, purchases of fixtures on credit from TS Supplies, $3,000 has been debited to TS Supplies and credited to the fixtures account. So what we find here is that there's a reversal of entries, right? So where we should have debited, we credited, and where we should have credited, we debited. Now, when you have errors like this, you find it in your general journal, firstly, and secondly, you have to multiply the figure by 2. Because if you have a debit $3,000 and you have a credit $3,000, when you're going to balance off, you're going to have zero. But you don't want to have zero, you need to have $3,000. So therefore, you multiply it by 2 so that when it's going to cancel out, one of the $3,000 will remain. All right. So in this case, 3,000 multiplied by 2 gives you $6,000. Fixtures was credited, but it should be debited. So you debit fixtures, and TS supplies should be credited, but it is debited. So you credit it now. All right. And it is the correct error of reversal. Now we're at 6. The total of the analysis column for stationery in the petty cash book, 150, had not been transferred to the stationery account in the ledger. All right, so this is a error that you will find in your suspense account. All right, so normally you would debit stationery, right? Because stationery is either an expense or, yeah, this seems to be an expense in this case. And you would credit the suspense account. So you get stationery as the details because that's where you're going to find the debit entry. And it's December 31st, 150. Now let us see if the trial balance is now correct. Yes, because the trial balance will be zero. We have 368 on the debit side and 368 on the credit side. All right. So when you add 18, 200, and 150, you should get $368. And let me double underline. My bad for my lines. Then we move on to C, the last part. Costco Sports Center draft income statement for the year ended December 31st, 2024 showed a net profit of $13,000. We're supposed to prepare a revised profit statement for Costco Sports Center for the year ended December 31st, 2024, taking into consideration the correction of those errors which would have affected net profits. So firstly, let us start with putting the name of the business and a title. So it's the revised income statement for the year ended December 31st, 2024. Look for your net profit, which they stated in the question as $13,000. So that's what you put down first. Then you're going to look for adjustments that will be needed. So what you would do, you read through each item to see which one would increase or decrease profits. All right, let's do that first. And I'm going to discuss them and then I'll just go back down. The total of a page of a purchase account was $6,842, but it had been carried forward as $6,824. Do you find the purchases account in your income statement? Yes. That is what you use to calculate cost of goods sold, right? Yeah, that's the top part of your income statement where you have sales, less cost of goods sold, add purchases. Yeah. So you normally use that to calculate cost of goods sold, which you minus from profits or from sales. So you have to minus this $18 from profits correct it. All right. A check received from DEC Limited, $1,500 had been credited to the account of DDE Limited. No, this does not affect profit. And why it doesn't affect profit? Because this is a supplier account. All right. Suppliers are not found on your income statement. They are found where? On your balance sheet. All right. The balance of a petty cash book, $200, had been omitted from the trial balance. Do we find the petty cash in our income statement? No. Good. Repairs to motor vehicle, $293, had been found in the motor vehicles account. Does this affect profit? Yes. That's 293. Remember that repairs is an expense. So we find expenses and income in our income statement. Purchases of fixtures and credit from TS Supplies has been debited to TS Supplies fixtures account. All right. Do you find this in your income statement or do you find it in balance sheet? Balance sheet. Good. And the total of the analysis column for stationery in the petty cash book 150 had not been transferred to the stationery account in the ledger. So in this case, it's an expense, and we find it in our income statement. All right, good. So we're going to pick up these three subtraction figures and we're going to carry it down to our revised income statement. So we put them down: purchases, motor repairs, and stationery. We add them together, we get 461, and this is going to be subtracted from our net profit to give us an adjusted net profit of $12,539. All right, so that is the end of the test. I think you would agree with me that is not hard. This paper was not hard, so it's just for you to revise. Remember that even though this one isn't hard, you are not sure what the other one would look like, the one that is coming up. All right, so just keep practicing and keep watching the videos. If you found this video interesting, please subscribe and share and like to someone. Share it to someone and like.